The European currency extended gains against the US dollar, adding about 150 pips. This can be attributed to updated projections from the Fed. Markets now expect the US central bank to pause monetary policy tightening. The Fed is expected to deliver its last interest rate hikes in December this year and then probably in March 2023. In the second half of the next year, the regulator may well announce rate cuts. Although Fed officials insist that they are going to keep rates elevated until the end of 2023, there is a shift in market expectations. This, in turn, boosts demand for risky assets, especially given that the euro is extremely oversold. Thus, a return to parity comes as no surprise. As for the pound sterling, it also continued its bullish run, rising by about 150 pips. The British currency was supported by the fact that the UK government went back on its decision to abolish the top rate of income tax amid the central bank's rate increases and the economy sliding into recession. Earlier, this decision led to sterling's steep slide to the area of 1.0360. To date, the quote has recovered and is currently struggling around the level of 1.1500. Now, its further dynamic depends on fundamental factors. Today's macroeconomic calendar is full of PMI reports from the Euro member states and the UK. Activity in the services sectors of Germany, France, and the euro area is expected to shrink. Britain's composite and services PMIs are forecast to stand at 48.4 and 49.2 in September, respectively. Notably, a reading below 50 indicates contraction. So, according to estimates, statistics will be downbeat. This may lead to a slowdown in the quote's bullish cycles. The United States is also set to report data on its business activity. Besides, traders may take notice of the ADP non-farm employment change. Analysts forecast a rise in non-farm payrolls of 200,000 for September. This may contribute to the dollar's rally and cancel plans of those who count on cooling inflation and a slower pace of interest rate hikes by the US Federal Reserve. Furthermore, the ISM's non-manufacturing PMI is anticipated to decline, but remain above 50, which may also back the greenback in late trade. Therefore, please be careful with long positions at current highs. From a technical point of view, judging by the 1-hour chart, it is worth focusing on the levels of 0.9952 and 0.9909. A false breakout will create a buy signal. In this case, the euro will advance to 0.9996. If the price breaks above parity and tests the 1.00 level from the top down, the way to 1.0040 and 1.0084 will open. At the mark of 1.0084, it will be possible to go short on a rebound with a view to catch an intraday correction of 34-40 pips. Short positions at 0.9996 and 1.0040 can be considered only amid a false breakout. If bullish trading activity at 0.9909 is subdued, I recommend going long on a rebound at 0.9856. Thus, one can count on an intraday correction of 30-35 pips. Speaking of the British currency, a false breakout at 1.1483 triggered a sell signal. Now bears are striving to drag the price down to 1.1419. If the price breaks through this level and tests it from the bottom up following downbeat data on services activity, the volume of short positions will increase further. In this case, the pound sterling will dip to 1.1360 and 1.1299. At the level of 1.1299, the lower boundary of the ascending channel, it would be a wise decision to buy the pair on a rebound, hoping to earn from an intraday correction of 45-50 pips. Long positions at 1.1419 and 1.1360 can be opened only in the event of a false breakout. Thus, the principal goal of bulls will be to push the price up so that it can break above 1.1483. Its top-down test will help the British pound advance to 1.1534 and 1.1584. At the level of 1.1584, I recommend going short on a rebound with a view to catching an intraday correction of 35-40 pips. Short positions at 1.1534 and 1.1483 will be relevant only amid a false breakout. Good luck!